This webinar is about the financial markets and the finance industry. The financial industry and finance institutions have long been criticized that interests of the client or the society has been sidelined from the way a company may work or how it earns its money. This debate has also reached the UN and has also helped shape the Sustainable Development Goals, which is the global world's work plan for what we would like to achieve the next 15 years. Two of the Sustainable Development Goals underline the importance of tax and capital flight for sustainable development and to reduce inequality both between countries but also within countries, and not least to build peaceful and inclusive societies. I will not hold the whole of the finance industry on your shoulders, but you represent an important financial industry. You are the CEO of Finance Norway, and you are very interesting to talk to as you're an actor within this finance industry. You have been the CEO of Storebrand ASA. You're the chairman of the board of Norway Post and Aschehoug Forlag. You're also the member of the board of the University of Oslo, and you're a member of the advisory board of the Norwegian School of Economics. In June 2015, you were also appointed member of the Norwegian Commission for Green Competitiveness, and from December 2014, you have been a member of the Minister of Climate and Environment's Climate Policy Council. And in 2013, you were also appointed member of the Strategy Council for the Norwegian Government Pension Fund Global. You have also been a member of the World Business Council for Sustainable Development, and you have co-chaired their vision from 2015. You have a Master of Science degree in Economics and Business Administration from the Norwegian School of Economics, and you have been engaged broadly with a broad variety of actors discussing finance and its impact on society. So perhaps I should just ask you first, why is transparency important for you as a business leader?
Transparency, thank you very much for the introduction. I'm almost exhausted just by listening to you. But as you correctly point out, I've had the privilege and opportunity to be able to work with some of the important questions and seen them from different angles, which is very, very helpful. And when it comes to transparency, to me, it has to do with predictability and accountability, which are two very key elements in all well-functioning markets. If it's transparent, it's by definition open. You can have insight. When it's open and you have insight, that increases your ability to predict what is going on. And if somebody says they are about to do something and they do it, that has to do with accountability. And if a market is based on people and institutions being accountable, it's easier to work in that market than the opposite. So in my opinion, transparency is a fundamental it's a fundamental platform for well-functioning markets. So the opposite, lack of transparency, is a market imperfection that increases the cost, reduces the efficiency, and fundamentally leads to wrong allocation decisions. And if we turn this into normal speak, what does that imply? Well, if it's a lack of transparency, somebody can misuse information, somebody can misuse power, somebody can misuse their positions to gain benefits that they would not be awarded in an open market where open parameters decided.
Could you define what is finance for us?
Yes, yes, because finance is put into this cloud of both suspicion and myth. To me, it's pretty simple. I mean, finance has to do with three basic elements. One has to do with helping people meet, where some people or businesses or institutions, they have more money than they need currently, and they want to invest their money, save it. And other people, they have investment opportunities. They want to buy a house, or they want to buy a company, or they want to buy a new machine, and they need money. So the first thing that the financial sector does is for them to meet in an as effective way as possible, so that you can transform savings into investments. And that is the fundamental platform for growth, value creation, jobs, and modern society. The second thing has to do with payments. I mean, to you, it's a pretty basic thing that when you go to the grocery store, it's easy for you to pay for the groceries you purchase. But it is a relatively complex system behind that, in particular when it comes to the very digital payment structures and systems we have today. And these systems, they are developed by and run by the financial services community. So that's job number two, to see to that payment systems work. Not only when you as an individual meet your grocer, but also when we trade cross-border, when we trade in professional contexts. And the third key element has to do with insurance. And you know, the basic principles of insurance is well known in Norwegian legislation back to the 12th century, where we agreed that in a village, which if the house of one of the inhabitants burnt down, the others, they were obliged to take part in rebuilding his house. So it's a sort of collective responsibility where we share risk on many, and we pay and contribute based on the risk we represent. And insurance is a fundamental condition for large investments, because if you do not have any insurance, you do not really take the risk of making a large investment. That be in a house, if you're an individual, or a large production facility if you are a company. So it's savings meets investment needs, it's payments, and it's risk sharing and insurance. That's basically what finance is all about. And if you think about what is the core competence behind all this, it is to understand risk and price risk. So that is what we do.
But could you, in order to explain through a few examples, could you explain some of the problems which the finance industry has helped solve in the Norwegian society?
One very clear example is has to do with payments. The thing that we all of us take for granted and as a given. Norway has one of the cheapest, most effective and safest payment systems on the planet. And that reduces the cost of every transaction we do as individuals and as companies. And that's done as a collective process where all the banks working in Norway agreed to work together to develop this payment system. And huge investments have been made. And as a consequence, we have very high productivity and we are an effective society. So that's one very concrete example. Another one, which is very recent, but is a relevant example in this in the debate about climate risk, is the way we collect claims data in the insurance industry and share the claims data with the public planners, enabling local communities and municipalities to increase their ability to build resilient local houses and industrial facilities, because they have the macro data about their municipality or their area. We have the micro data. We know exactly when and where things have happened over the last 150, 200 years. And by sharing that data, we also enable us to predict what will happen going forward and see trends. And sharing that kind of data is a part of us contributing to solving current societal problems.
But as I mentioned in the beginning, the financial sector has also come under a lot of critique. In how you see it, which problems has the industry of finance created? I mean, it's impossible to answer that question without commenting on the recent financial crisis, 2008, 2009. And just to recall what happened, it all started by banks in United States lending a lot of money to house buyers that could not, and they should have known that they were not able to pay back their loans. And they bundled these loans into large units, which were got a stamp of approval from Moody's and Standard & Poor's and the guys that should know a little bit about risk. And then the large pools of risk were divided into small pieces, collector debt obligations, CDOs, and sold in the market. And when people started not to pay back on their house loans, that was the start of something that had ripple effects through the financial markets and led to not only a financial crisis, but also an economic downturn, significant economic downturn. And for some countries, like in Greece and Spain, also led to societal and political crisis and a lot of hoo-ha. And then this example is also a good example of the interrelationship between the financial economy and what you call the real economy, because the financial crisis was no doubt triggered by what happened in the banking sector in the US. But it would not have had the immense effects if you hadn't seen at the same time fundamental flaws in policy making and in how the public sector had acted. For instance, the debt levels of Greece was unsustainable. But you see that things that happen in the financial economy spread into the real economy, and then you have a crisis. So, to go back, one part of the answer to your question is that the financial system is, according to the Harvard historian Neil Ferguson, the most complex structure, man-made structure on the planet. It's the most complex man-made structure on the planet. And it is inherent risk in the system. So the question of financial risk, financial stability, systemic risk linked to the financial services sector is a key element. And what has happened on regulation over the last 5-6 years after the financial crisis has had as an objective to target these risks and reduce them and make them manageable. So that's one key element. The other key element has to do with the relationship between what financial institutions do for their customers and what the financial institutions do for themselves. One of the largest banks in the world, Goldman Sachs, has been criticized because
more than 50% of their P&L comes from activities where the bank act on their own behalf and not behalf of their customers. And that may lead to classical principle and what is it called? Principle and agent problem. Who are the bank? Are the bank an institution working for its customers, or are the bank an institution working for itself? And if you come to, if you look to Norway, the financial institutions in Norway, they are clearly institutions working for the customers. The book they have on their own account is, I mean, tiny. So very, very, very small proprietary trading and proprietary risk taking, which is in our context a transparent system. But when banks and financial institutions increase their own trading book to proprietary trading and work by themselves, they lose transparency, and it's hard to see if they do things to maximize their own profit, or they are doing things to maximize their customers' profit. So that's criticism number two. Criticism number three has to do with the fact that the financial industry may be misused by the bad guys to cover up for illegal activities. I mean, most illegal activities have as the fundamental objective to create money, to get money out of something. And for that money to have a value, it has to be taken from the black economy into the white economy. Of course, a part of the money generated from in the black economy will be reinvested in the black economy to further grow their illegal activities. But ultimately, some of it has to be transferred or transformed from the black economy into the real economy. And that's whitewashing. The banks, the insurance companies, may be used and misused as tools for the bad guys. And we have very recent examples now. I came back from Copenhagen yesterday, and it's a big discussion now about the whitewashing affair that the Americans pointed to the Baltics that has now spread to Denmark, where banks in Denmark are accused of sleeping instead of being active enough. If that is right or not, I don't know. But it is a very current example of how the banks and the banking system may be used and misused by the bad guys. So we need to have systems in place to prevent that from happening. So that's criticism number three, and I think that it's fair to say that criticism number four has to do with that we have historically focused on performance and profit, and to a large extent, and to a too little extent focused on the consequences of how that profit is made, has been made. And over the last, let's say, 10 years, a lot has happened in this area, where you see that investors are taking more responsible investment decisions. They say that we will not generate profit and return based on investments that's not in line with our core values. That has to do with child labor. It has to do with certain weapons. It has to do with climate change. It has to do with corruption. It has to do with human rights. So a large number of areas where the financial services industry historically has said that, well, we are just the money guys. So we are not the guys building the dam or pulling the trigger or doing anything wrong. We are just financing this, and But the product responsibility, the fact that some of these activities would never happen without financing, that places a responsibility with the financial services sector. So and we are starting to take that kind of responsibility very, very seriously, trying to understand it and implement it in our processes. And perhaps the last criticism has to do with the lack of correct pricing signals. So everything we do is more or less based on discounted cash flow. I mean, it's a DCF analysis where you make an investment and then you look at the possible return and you look at the risk for that return to happen or not. And carbon pricing is not included in that if not somebody has put in place a carbon price. The cost of earth erosion is not put into that unless somebody has placed a cost on that. So to see to that and help develop right pricing signals so that the right and the fundamental societal costs are included in investment decisions has been an area of focus. So yes, we have been criticized for a lot, but having said all this, I think that finance is a force for the good and a necessary force for the good. Without an effective finance sector, good things will not happen.
But this is also a sector which has been in, as most sectors these days, it's developing very, very quickly. In the industrial period, we knew what the raw materials were. We knew what the production was. Mm-hmm. What is the raw material in the finance industry? What are you buying?
It's a very interesting question. So, some people have said that, the entire financial system is an intangible system. It's based on trust. So as long as you and I believe that the numbers we get on the screen represents real money, we accept that we have money on our bank account. But that if we start doubting that and just see it as numbers on a screen, that undermines the fundamental system. So you might say that the fundamental thing that the entire financial system builds on is trust. And if you take that as an assumption, that leads you also to a lot of other things that we are discussing now. That what are the things that build that trust and what are the things that destroy that trust. And we should care a lot about that because it's so important for the entire system.
You were talking a little about the real economy and the finance economy. Could you say something more about how much involved is the real economy and the finance economy? Is it possible to divide the two even?
I really do not like the division because, traditionally in the analog industrial economy, it was more meaningful to say that, well, you had some production facilities where you put in some raw materials and things happened in a factory and some end products came out and they were put on a lorry and transported out to the markets and somebody bought them. That's the real economy. And then they had to borrow money and they had to invest money, and that was the finance economy. But in the digital world we live now, the distinction between the finance economy and the real economy is really blurred, and it makes less sense to speculate about the division. The economy is the economy, and the finance sector is an integral part of it.
But the definition of finance, there was a prize-winning economist, Robert Shiller. He tried to define finance as the science of goal architecture, of the structuring of the economic arrangement necessary to achieve a set of goals and a stewardship of these assets needed for this achievement. Is it an accurate definition?
I mean, it's a definition worthy of a Nobel Prize winner. And yes, I think it's I think it's a very, very good definition, but it's not. I mean, it's not a workable definition for everyday life. But if you go into it and use that definition, for instance, on investments, what you invest in if you buy shares in a company, that is number one, the goals that company has set, and the likelihood of the company meeting their objectives, and the risks that can affect the probability of meeting their objectives. And that is when I say that our business is to understand risk and set a price on risk. That is exactly what Schiller is pointing at.
Today, the business model chosen by some of the giant technology firms, such as, for example, those companies who have been all over the media lately, Google, Amazon, Facebook, Apple, Microsoft, their business has hit the traditional media business midship. The Norwegian media has lost half of their revenues to a tech company using a third country in its business strategy. They have also lost 50% of their workforce. These giants also benefit from a network strategy. The larger they become, the more customers they attract, the more other businesses they buy up. And they are also now looking towards other sectors. For example, banking, which is another market and very much tech-driven, and also the insurance industry. And suddenly we are into finance, the business that you represent. Can the same thing happen to your sector, or is it already happening?
No, I mean, absolutely. Speaking about this from a Norwegian point of view, Microsoft Messenger is being introduced as a payment service in Norway this spring. Apple Pay will be reality for the mass market in Norway before the summer. So when you see what we are doing on our end, taking Vipps from being owned by DNB to now have 110 banks as owners, merging Vipps with Bank Accept, which is the traditional payment system, merging that with Bank ID, which is the digital identification system that backs this. That is a way of the incumbent system to embrace itself to meet the competition from the giants. And if you look at it, the giants cost, and this is the advertisement from the finance sector in Norway. If you look at the cost of using Apple Pay, it's between 5 and 10 times the cost of using Bank Accept. So we are pretty determined that we will be able to go into that competition in a strong way. Having said that, disrupting forces are very strong in the financial services industry. I talked to the technology director in IBM, the guy responsible for Watson, and I asked him which are the industries that will be most affected by Watson and by artificial intelligence and the next phase of digitization going forward. And he said the answer is very clear. It's healthcare and finance. You will not be able to recognize your business in a couple of years. But that is nothing new to finance. I mean, if you look at it, finance has been in the forefront of transformation always. And also, if you look at productivity increases, the average productivity increase in finance for the last 25 years have been more than 180% compared to 45% in land-based business in Norway outside finance. So this is a part of the business. We are not stiff by fear, but we are bracing ourselves for very tough competition. So that's the finance part of it. But the other part of it that is extremely important to think through is, let me at least comment on two sides of the business, the digital business models. One is what you might call superstar economics, the winner takes it all economy. You mentioned the Industrial Revolution, and what happened in the Industrial Revolution was that we supported capital as an investment in machinery, which enabled unskilled labor to come into the factories and increase their factor productivity significantly. And this happened on a broad basis. And as a consequence, each and every one of them got a higher salary than they had before, and the value creation in society increased significantly. And the fact that factor productivity of labor increased as a consequence of each of increased investments in machinery, that was the fundamental platform on which we built the modern welfare societies in the Western world. What is happening now is exactly the opposite, because now we are introducing new technologies that will reduce the value of 1 hour's work for a large number of people. But it will increase the value of 1 hour's work for the best software developer or for the founder of Facebook. So you have a very, very strong allocation of resources on very, very few hands. And the societal implications of that we have yet to understand and yet to take seriously enough. We need to think that through. And the second part of it is to finance society. I mean, Apple, they use university graduates. They use the infrastructure, electricity infrastructure that's been built. They use the systems that's been built by a collective effort. But as a company, they participate very, very little in developing that collective effort. They do not take their relative collective part of the responsibility. And over time, we cannot have that. So we need to find systems both much more inclusive when it comes to the labor force, but also when it comes to taking part in financing what you might call a well-functioning society. And important part of that is tax evasion. I mean, tax evasion seems to be an integral part of the business models, and we cannot have that.
But we're also talking about raw materials of the big companies today. Many of the companies we talk about, they basically have to channel their revenues into third countries, secrecy jurisdictions, and from there they have to work somewhere. They can't just stay there. So on the one hand, they have to take up big loans in order to pay out dividends to investors. At the same time as they often channel their funds into, for example, equity funds. And their investments often again goes into public sector. Because it's a safe, predictable economy. Buying up stuff, but when they're done, they're not much revenue left for the country itself, and they keep on moving. It seems like there are two to different negative effects from that business model working at the same time.
Yes.
How strong is that, do you feel?
I think that there are discussions about effective tax rates for some of these large companies, but if you look at US, where they came from, I mean, the plumber on the corner, he had to pay 35% taxes on all his income. But the large tech guys in Silicon Valley, they paid a single-digit tax had a single-digit effective tax rate, which is fundamentally, of course, unfair. And that has huge consequences. So that's one element. And in that context, it's also interesting to note that, for instance, in Norway, we have a tax system that benefits investments in machines because that's deductible for tax purposes. But you are penalized if you invest in people. So we have to think through the tax system on a number of directions in the new digital economy. We have to tax less the thing we want more of, and we have to tax more the things we want less of. So that's one part of it. So tax system, both nationally and internationally, is a very, very important issue going forward. But the second part of your question, how the money is being invested, it is of course not necessarily a bad thing that this money is invested in government bonds, financing a public sector. If the public sector is well run, I mean, an effective, well-run public sector is a good thing for the economy. If they provide good schools, if they provide good hospital, if they provide effective transportation systems, it's a good thing. But you have also seen that economies like, for instance, Greece, have had to sell their airports, sell their harbors, sell all their public infrastructure to pay the debt that arose after the financial crisis. And that is, of course, something that reduces the value of the balance sheet of the country. But that in itself is not necessarily negative if the proceeds are spent in a good way. So the point is to also here be transparent and hold politicians accountable for how they manage public money. And if you look at this on a greater scale, the new climate economy, they came a couple of years ago with a report, Better Growth, Better Market, estimating a need for public investments in new infrastructure of $90 trillion within 2030. $90 trillion within 2030 to finance the transition from hydrocarbon-based energy system to renewable energy system. And everybody knows that those $90 trillion is not available as a part of public finances. You have to have private investors, private money being attracted to this kind of investments. So that is not necessarily a bad thing.
But in this aspect, we also know that the finance industry has come up with some very, very creative financial instruments, which can bring huge problems into a small Norwegian municipality who clearly is not knowing what they are doing, and which is not healthy for the municipality or the local economy. So there are a number of issues which are potentially dangerous and problematic, often due to lack of information, information asymmetry, and perhaps also trying to evaluate future profit or ways of introducing fair value mechanism which can have very, very harmful effects. Are there any concrete responsibilities that the financial sector itself can take or are discussing to take in order to help achieve transparency, in order to be a part of a good alliance, to make the financial sector healthy?
Absolutely. The answer is clearly yes, and I think that the fundamental relationship that more and more people are getting aware of is the fact that business cannot work in societies that fail. It is a clear interrelationship between healthy business environment, and healthy societies. So we cannot exploit a society short term and imagine that you're able to build long-term business models. So business and finance has to work together with society to build sustainable business models in sustainable societies. And we talk about alpha as a token of market return. And if markets fail, if societies fail, then the cost of doing business increases and the growth prospects are being reduced. So the expected return is being reduced. So it makes no sense for business to work short term, exploit society short term, and try to build long-term business models. This has to go hand in hand. Having said that, you are pointing at financial innovation, and financial innovation is a good thing. I mean, financial innovation leads to the discussions we have with the World Bank now about new financing solutions that will significantly increase the effects of public money being spent in emerging economies, where public money is put in to take care of very certain risks in a project, and by taking care of those certain risks in a project, that will attract huge amounts of private money. So you have the multiplier effect that enables you to lift projects faster, better, with better results, and you can help more people quicker. So that's also financial innovation. But you have a number of examples of financial innovation that leads nowhere, and you have a number of examples of financial innovation that takes us, society, the customers, and also the financial institutions in the wrong direction. And there are two elements of that. One has to do with the customer. I mean, to the customer, we need to say that if it looks too good to be true, it probably is. So I mean, be careful. The second thing has to do with us as an industry. We live of trust, and it's extremely important to take the extra round and think through the new product. Even if it sells on the short term, will it create or destroy trust in the longer term? And that's a necessary question to be asked.
Regarding the public or the society, I think the main thing in order to establish trust is when a taxpayer pays its tax money to a common good. It might benefit yourself, it might benefit somebody you don't know, but it benefits all of us. You would like to follow the money. How can we follow the money when there's no transparency? Many financial industries or businesses do not provide the necessary transparency and or accountability. My question is, can the finance industry help pushing transparency so that transparency can be a business advantage for the financial industry itself in order to create trust?
Yes, I think so. And we both, Mona, have worked enough with this to see the dilemmas and understand the complexities. But I think it's extremely important that does not lead us to the thought that it's because it's difficult we shouldn't do it. I mean, we should definitely be a part of an active force for increased transparency because it's the right thing. It's the right thing for the markets. It's the right thing for effective allocation of resources, and it's the right thing for building resilient local communities and societies in which business can flourish. So we should absolutely do that, and yes, we can do that. But one of the important things we can do is to take part in developing international standards. Because one of the dilemmas is that you do business in a country where you have rules and regulations and authorities benefiting from the lack of transparency. And if you come in there as, hi, I'm the good guy from from Norway, like to do business in your country, and I like to turn everything upside down, then you will not probably be the preferred business partner. But if we come in there backed by international standards, backed by a transparent regime, then we say, well, this is, as you know, this is the business standard on which we base our business model. So that's the way it is. I think that one of the most meaningful things we can do is to spend time helping and developing both the understanding and the implementation of healthy international business standards. And that can we do also on a national level. As you know, Finance Norway have participated in a work with Tax Justice Network to develop a model for open ownership in Norway, framing out how we can make a register being even more transparent when it comes to who are the ultimate owners, which is a part of the transparency we would like to see. And to me, that's meaningful. And yes, we would very much like to do more of it.